Hello, my name is John Satterfield, and I'm the branch manager in the Muni Little Rock office. In today's video, we want to explore ideas for investors during inflationary periods. A good place to begin is to estimate the length of the current inflationary trend and to have some sort of projection as to where the inflation rate will settle. An impossible task to be completely accurate, but a place to start nonetheless. So, what do we know? The Fed is stating that it will raise rates until inflation is lowered. One can project that the Fed will eventually complete this task. When? Hard to say. By the end of next year? Longer? Will inflation go even higher? Okay, so let's assume the Fed is successful. Now what? Let's start with the assumption that inflation begins to wane to much lower rates by the end of next year. The current inflation rate is roughly 8% as of October 2022. There are two components to consider now. What to do with new investable funds, what to do with current holdings. We'll look at the new investable funds question first. Is there anywhere to invest currently that can provide an 8% return? Not many, if any at all. However, we know that the yield on the shorter treasuries is in the 4% range, about halfway there. What will rates be when the short-term treasury comes due? Some corporate bonds are paying even higher, approaching 7% interest. Now, there are too many factors to discuss here to bring specific examples, some of which are the bond rating, maturity date of the bond, price of the bond, how much to invest into each bond, and on and on. But I do want to encourage anyone watching to pick the phone up or call, send us an email at advice at amuni.com. So advice at amuni.com for further investigation into bonds as an inflation investment idea. Additionally, there are some dividend yields from stocks which can offset the current inflation rate. While there are again too many factors in this category to mention, one of the main keys to focus in on with stock dividend idea is to stay with companies that have a history of steady dividends, even through the pandemic. Now the stocks, as we all know, carry some market risk, but the dividend yield can mitigate this to some degree. Be sure to email or reach out by phone for more in-depth discussion on this concept. Now, the second situation to contemplate here is what to do with current holdings. This is even more nuanced for each one's own circumstance. For those that are holding bonds, you can look for the shorter maturities or pre-refunded municipal bonds and consider moving these to higher interest bonds. Same can be considered for some stock positions, moving to higher dividend paying stocks. Once again, there are multiple factors to consider here. Sector, dividend history, PE ratio, beta, which is the price fluctuation compared to the S&P, style, the small cap, mid cap, large cap, on and on. Shoot me an email and we can go more in depth or review your portfolio. One last consideration is that if you can invest into higher interest or dividend yields now and inflation continues to wane, your investments will be giving you a positive return over the inflation rate in the future. Please reach out to us at advice at amuni.com. That's ADVICE at amuni.com, or call us at 800-868-6864. 800-868-6864. You can also find more information about us on our website at amuni.com, amuni.com. Thank you for watching, and if you like the video, please don't forget to subscribe and share with family and friends. Thank you.